Okay, good morning. It is Thursday, 22nd of February, so I hope you're all well and had a good evening. Quick overview of what we're going to cover here. Usual routine, I'll talk about some of the news events that have happened, in particular the FOMC minutes last night, how the market reacted to that and why. Then I'll look at a few other things, oil inventory numbers from the API last night, obviously delayed a day because of the US President's Day holiday on Monday. Then we'll have a look at a couple of corporate earnings, being probably the most busiest day for UK and European earnings. And then I'll hand you over to Sam, and he can look at a couple of the charts and setups for today. So, as per usual, just a quick overview of how the general asset classes are faring this morning. And European equities are trading negative territory, albeit we are off the lows, as you can see here in the centre left, in regards to the DAX. The Euro Stoxx, a similar price pattern. But net, we did gap slightly lower, and we are down about 100 points at the moment in the terms of the DAX. This came obviously after a really big decline that we saw after initially moving higher, a big sell-off into the close on Wall Street last night, and that continued into the Asian session, and hence you've had this carry through of a kind of a negative sentiment to the open today. I'll explain that in a bit more detail in a second and why that US move happened. But looking elsewhere, generally the dollar strengthened last night. In terms of the dollar index at the moment, it trades a 90 handle, so it's basically flat. But the dollar was, it took heed from the hawkishness of the FOMC minutes, strengthened and held on to that gain overnight. So consequently, as you can see in these major pairs, it reflects that dollar strength move. So if we look on the top left, you can see that large volatility on that wick at the release at 7 PM last night, and then a general trend lower in euro dollar. Before then, we found some support on the daily S1 pivot level this morning. Likewise in cable, similar story. Some volatility seen at 7 o'clock, you can see here, and then the prevailing dollar strength meant that the pair broke the earlier day's low and then moved down to also find some support around S1 this morning, but we've recovered back to the previous point of support, so an interesting level we've just recovered back to here in the sterling currency. Playing the similar theme, given the interpretation of the minutes and the strength of the dollar last night, gold also seeing a downward trend, and we remain down about $7 this morning. So all of this movement obviously is a byproduct of what happened in the announcement of the US last night. So this is what the situation was. And what was very interesting was a kind of two-phase reaction that you had to the Fed minutes. The initial one, let me just go back to the chart, and I think the S&P tells quite a nice story in terms of its price movement. If we put the S&P on a shorter time frame, what you're looking at here is the initial reaction. So this is this period here. So then the reaction thereafter going into the close on Wall Street. So if we were looking at different, I guess, phases to this move, you could say this is the initial reaction, and then you've got the interpretation that came thereafter going into the close. So this is a really interesting way that fundamentals can have an immediate impact, but then upon digestion you can see quite a distinct shift in how people have then interpreted the information that has come out. Something like the minutes is definitely one of those situations where this can happen quite a lot, and the reason for that is because the mechanics of how this information is released. If you think about it, the major news agencies already have the full minutes, which they've read half an hour under embargo before the release time of 7 PM when they drop all the comments out. Now what they would have done is picked several headlines, and then they dropped them all simultaneously on traders via the terminals. And so you get this initial kind of knee-jerked response where you're just going off headlines. But then typically what happens is that after a period, and as we've seen here, the S&P actually rallied for approximately half an hour. We hit fresh highs. Before then, you started to get a second phase of the move, which was after the dollar initially weakened, equities rallied, the complete opposite. So this is what you have here, is a dovish reaction where people's initial response was actually, well, they're not really, because there was this obsession. What does further mean when it comes to gradual kind of rate normalization? And the initial response was, well, they've not committed and said they're going to go from 3 to 4 hikes explicitly. So therefore, this is dovish and we rally. However, then when you start cutting through the details of the actual minutes themselves, you quite quickly realize that this is very hawkish, in fact. And then actually, this is quite a big sell-off for the period of the last 2 hours of Wall Street trade. In terms of the S&P, if you think about it, we're going from a 27.50 price point all the way to sub 27 handle. And that's a pretty punchy move. And then that's when you saw the dollar strengthen, the pairs against the dollar weaken. So why did this happen? And why did people have an overreaching hawkish view of what was said? Well, let's check out a couple of things here. And US economic expansion is set to gain momentum, hardening the arguments for higher interest rates. That was the take home from the minutes. A number of participants in the end of January meeting said they'd marked up their growth forecast since the previous month, encouraged by firm growth, supportive financial markets, and the potential US tax cuts to boost the economy more than expected. Others went as far as saying upside risks to growth may have increased. So all of this, a majority of participants noted that a stronger outlook for economic growth raised the likelihood that further gradual policy firming would be appropriate. So all of this language is quite optimistic about growth conditions, and as a net result then, what could potentially influence, if there's upside risks to growth, then you would imagine then the reaction to this is going from 3 to 4 interest rate hikes, as is what is believed by quite a few big banks on Wall Street. The other really important thing to identify as well with this minutes, this is of the meeting of January 30th to the 31st. Remember, this does predate things like that really strong wage data that we saw that initiated that market sell-off. So this is conversations that were very optimistic even before they've seen this renewed pop higher in wages, which would be even a more hawkish situation, and also before they've seen a slight uptick as well confirmed in the actual CPI data we had last week. So hence the reason why, if they're already optimistic, then you throw in wages are going up and inflation is increasing, then hence the reason why this should position them for being potentially more hawkish to signal a rate hike not only in March, which is albeit priced in. This is the latest this morning according to the CME Fed Watch, which is a measurement of short-term interest rate futures. A rate hike for March is now priced at approximately 85%. And so what people will be expecting then is for the Fed to telegraph in that meeting that not only are they going to hike, but they're going to release the latest summary of economic projections, which could see an alteration then in the dot plot matrix for a more steeper trajectory of interest rates. So this is, it's really interesting actually, the developments that have unfolded from the conversation and tone of those minutes. Other considerations here, obviously the bond market has been a big feature and a topic of discussion going forward, because we're getting awfully close to the 10-year Treasury yield touching 3% as people interpret this rising of inflation expectations and consequently the reaction effect for monetary policy. This was quite an interesting read. If you do get a chance to have a look, this is the bond market guide to trading when the 10-year Treasury yield hits 3%. So obviously a little bit presumptuous that we're going to get there, but it looks like we're on track to definitely the 10-year yield to trade above 3%, which would be the first time since January of 2014 if that were the case. So this is kind of a couple of charts that were quite interesting. So you can see here the speed of which we've seen the 10-year yield pick up really since the beginning of the year, going from what was really key was the breach of the 2.5% and then that 2.6% from the early 2017 high, which has really opened the door to a surge in yield since that point. The question would be then technically, where do we go if we breach 3%? And there's a couple of historical technical points of interest, and really you've got to go all the way back to 2011 when we were up around the 3.2 3.25% level, and then way above there, up knocking on 3.75% at the beginning of 2011 if we were to breach that key psychological 3% level. What are the Fed members saying? So Quarles, the Fed member, says US economy is in the best shape since the crisis. Now, you might not recognize this chap. He's relatively new as terms of a Fed member, but let me just refresh your memory quickly. This is the Hawke-Dove scale, and Quarles is a board member, so he's going to be a permanent feature and voter for the next 3 years in terms of the FOMC, so he's an important person. But as you can see, sits pretty much bang in the middle of being neutral, neither dovish or hawkish. But obviously if you take the tone of his comments, so he's talked about, delivered an upbeat assessment of the US economy, endorsed a gradual path for raising interest rates in his first public speech. US economy appears to be performing very well and certainly is in the best shape that it's been in since the crisis by many metrics since well before the crisis. So, you know, reading between the lines here, even though he's neutral, obviously he's still sounding quite optimistic about forward-looking conditions, and therefore would be a backer, you would think, of this sequence of incoming interest rate hikes. What have the big banks been saying? Well, you probably would have caught this comment if you were trading last night. Goldman Sachs have come out, and their US chief strategist has basically said it's possible the Fed could deliver 5 interest rate hikes. Don't forget, the Fed currently have mapped a communication strategy to suggest that they're going to do just 3. Goldman's now, their baseline scenario is 4, and they're talking about possibility of 5. So, a couple of things here that the chap at Goldman's is suggesting. What they're saying is that essentially they think that there's upside risk to their baseline forecast, and think that the market might not fully appreciate it, i.e. there could be potential 5, not 4 rate hikes. You know, this is much more hawkishly positioned than what the Fed are currently communicating. One thing that to justify this view, he's basically said that 3 rate hikes in the December dot plot, but the projections in their view already felt a bit dated at the time and not really in sync with their economic projections. And it feels even more dated now that the fiscal stimulus has grown and inflation and wage data have finally shown signs of life. So those aforementioned things that we've seen, the wage data in payrolls, the pick-up inflation in CPI, and then also the corporate tax plan now delivered by Trump, this fiscal stimulus he's now pushing, are all bullish signals to think that economic growth should continue to expand and then warrant more interest rate hikes. Not only that though, Goldman's supplement their view with the fact that they think that there's signs the labour market is overheating and more likely to create anxiety at the Fed, that they feel the need to pick up the pace. So basically saying then that I think under these circumstances it would be very natural to consider acting more aggressively and picking up the pace. Now don't get me wrong, Goldman's is just one bank with one view, and they're not always right, but definitely it's quite interesting to see that if you were looking at the broader assessment of all the banks on Wall Street, we're generally moving up, the kind of the ante in the tightening focus that the Fed could adopt going forward. So that's kind of why the market reacted like it did last night, and that's why we're kind of set up as we are this morning. This is kind of a net reaction, the negative open in Europe to what occurred last night, with quite an aggressive sell-off and move in the market. You can see treasuries as well, pretty steep move as yields were elevated, and so it's almost the reversal of what we were so used to post-financial crisis. If you remember, a lower interest rate environment, large levels of stimulus via things like unconventional measures such as QE was lifting bonds and equities. Now what we're getting, if you look at the charts from last night, is the complete flip reverse of that. You've got here on the right hand side S&P and T-notes, and they essentially map each other exactly. So this tightening or view of tightening of policy is a net negative for equities, a removal of a low interest rate environment, but also is obviously bullish for yields, and so the price of the bonds are coming under pressure. Okay, a few other things just to have a look at. I did mention earlier that it's been particularly busy for corporate earnings, and so this is what the current leaderboard is just for the FTSE, but there has been a number of European earnings as well. But I just wanted to give you a flavour of, definitely in these sorts of days, if you were considering trading the FTSE or in fact any European index, you've got to be aware of the single stock movers, because if you look at, let's just take the top 3 of the gainers, the best gainers in the FTSE 100 and the biggest losers. So Barclays are up about 6% this morning. Their latest results have been warmly received despite a hit to profits from their sale of African operations and US tax reforms. Their shares actually on the other metrics coming in better than expected, so their shares up quite sharply. Centrica earnings, BAE Systems was earnings, British American Tobacco and Anglo-American, these are all earnings related moves. And for a single stock to move percentages on a normal day of 5%, that's a pretty decent move for a one-day move. But equities are very responsive to their earnings reports. The other ones we've had out of Europe, bigger names, Bouygues in France up 2.1%, AXA pretty flat, Deutsche Telekom now in Germany down about 2%. Okay, final things to have a look at. We did have the delayed release of the API crude oil inventories last night, owing to the US bank holiday on Monday. So if I just bring up my oil chart firstly, just to show you the price reaction, and then we'll look at the reasons why that happened. So if I just highlight for you when this came out, which obviously is a regular time at 9:30 last night, we did see a little bit of an upward move, but that failed to be sustained. You can see oil came under some pressure post the minutes, just given this kind of generalized move we had cross asset on the back of the FOMC announcement from the minutes. We have steadied since though, albeit we are slightly lower from the highest point from when these API numbers hit the tape. Now the initial reaction though was a bullish one. The headline crude number was a drawdown just shy of 1 million, and obviously this is a far much more bullish scenario than what was expected on the street, which was for a build of 2.9 million. The other numbers, Cushing, a draw of 2.644 million, that's a fairly sizable drawdown as far as the Cushing number is concerned, but gasoline was a build of about 1.64 million. So nothing really too outlandish here in these numbers, but we'll be recapping these obviously ahead of the DOE numbers we'll get later this afternoon. Quick look at the day ahead. You do have German IFO coming up, so I'll try and wrap things up quickly. Overall, in summary though, I wouldn't be expecting too much from IFO. We had the ZEW number yesterday, was a touch higher than expected, no real move in that regard. But the IFO one typically is the one that's more important because this is the companies that are surveyed for their forward-looking conditions. But just wanted to show you, this is IFO on the headline reading, and really it is in a very good place at this point in time, i.e. relatively strong. In fact, if I start putting this on a 10-year chart, it's about as high as this data point has ever been. So even if we hit the lower bound of the number, this definitely isn't going to change the view, I think, of the general state of play and people's outlook within Germany. A few other things quickly just to comment on. I'd still be on the lookout for any Brexit related rumours, leaks, source reports, these types of things. To give you an idea, there's a meeting happening later on today where Theresa May and her senior cabinet ministers are going to be meeting later on tonight, and apparently they're going to be working till the late hours to finalise some kind of agreement so then she can start putting together the blueprint for her speech that she's going to deliver next week, which obviously has a lot of importance as it will outline then Britain's kind of stance going into this transitional situation, which we'll get in March to discuss with the EU. So you could get a couple of leaks. I would imagine, though, they probably won't come till later this evening in that regard. Talking of Brexit, looks like we've just had a little bit of pound movement. So let me just make the sterling chart a bit bigger. There's been a headline that's just come out. Doubts Brexit transition to hit March deadline, as an EU official has just said on Bloomberg. Now it looks like that headline has just come out the last few minutes, might explain that little dip, but it's failed to sustain the move here. So Europe an undisclosed official saying doubts Brexit transition to hit the March deadline. So this would be a negative situation for the pound, but it doesn't look like the market has reacted too aggressively to that comment. But this is the type of thing I'm talking about. You've got a lot of headline risk, if you like, to what could be said today and going forward. So if you're in a sterling position, I would suggest that you need to be fairly prudent with your time frames of sitting in a position for too long a period of time, because you could get caught out by a spike on the back of headlines, which are likely to intensify going forward. Final thing I just wanted to show you, and this is away from kind of day-to-day markets, but Amazon shares hit 1,500 last night for the first time ever. And I just think that this is really quite interesting, the context that we've had just this very week. If you remember, 2 days ago, Walmart shares closed down over 10%, lost something akin to $25 billion off their market capitalization. So bricks and mortar type retailers, it's just becoming ever more apparent that they're kind of yesterday's news. And this behavioral shift to people becoming more drawn towards, just buying normal consumer goods via online, and Amazon is definitely there to facilitate that role. We're seeing their shares just continue to really knock it out the park. I mean, year to date, Amazon are up 28%. This is after a more than 55% climb in their share price last year. So just quite incredible to see. If I was mapping Walmart, they've pretty much done the opposite. All right, I am going to come off the mic, and actually I'm just going to ask Sam to post some charts into the chat room so we can finish this briefing and keep an eye on IFO, which is coming out in the next couple of minutes. So Sam's not going to come on. He'll be in Trading Live though throughout the whole day. If you want to talk to him, I'll get him to post some charts that he sees as quite interesting as setups for today into the room. But I'm going to let you guys just crack on and get on with the trading for the day. Okay guys, have a good one. Catch you later on. Thank you.